Consumer inflation has slowed slightly but remains elevated. According to Stats SA data, consumer price inflation rose by 7.6% in August on a year-on-year basis. Market expectations had factored in a slowdown in the pace of inflation. On a month-on-month basis, prices rose by 0.2%. The main drivers of the latest 7.6% print were food and non-alcoholic beverages, housing and utilities, transport and miscellaneous goods and services. Worryingly, food inflation jumped by 11.5% year-on-year, with the usual suspects of bread and cereals and oil and fats leading the inflationary charge in the category. The transport category increased by 21.1% year-on-year. This data comes on the eve of the Reserve Bank's monetary policy decision tomorrow. All expectations are another increase in the repo rate, with a large move expected in line with big moves in other economies. Well, to unpack the data for us, I'm joined by Koketso Mano. She's an FNB Senior Economist. Thank you very much for joining us, Koketso. So inflation is still quite high. It's above 7.5%. But what do you see as some of the factors that help to temper the August number?
Yeah, and I think we've covered most of the trends that we've picked up in the latest data. As you said correctly, unfortunately, food and non-alcoholic beverage inflation continues to post quite strong inflation. Here we saw cereals picking up quite strongly and contributing the most to this number. And I think the one thing to pick up from food and non-alcoholic beverage inflation pressures is that when you think about the lower decile groups or the lower income groups, which SABC also publishes inflation for, you will see that for the lowest income groups, that number is sitting closer to 10%, currently at 9.8%. So those pressures are really going to come through and affect the lower income groups quite strongly. And now just to get back to your question, some of the factors that are pulling from headline inflation or shaping off of the pressures from headline inflation would include your fuel inflation. Here we saw fuel was actually decelerating on a month-on-month basis. We saw deflation of 3.8% compared to July. And this would be thankfully following the R1 per litre decline in petrol prices in the month of August. We also had 80 cents decline in diesel prices in that month. So that what fortunately supported inflation lower. However, when you compare it to a year ago, I mean, fuel inflation is still sitting above 40%. So a few fundamentals still to work through in the coming months. I think food inflation poses the most upside risk, as we have seen in the latest data. However, following what we're seeing in petrol prices, we currently have an over-recovery in those numbers. If you look at the Central Energy Fund data, the over-recovery for petrol is sitting at over R1 per litre. For diesel, we have an under-recovery, but that has been narrowing of late. So we might likely to see another petrol cut coming through in October. So fuel dynamics are supporting inflation lower, but I'm worried that food inflation is going to provide upside pressure.
Yeah. Sticking on the issue of food inflation and the impact that it has on poorer households, I think one of the problematic things is that even though we can see fuel prices come down quite dramatically over a number of months, we might not get that with food inflation. It's sticky on the downside, right?
Correct. And I think one of the other worries, and we've mentioned this in other interviews or notes as well, is that, elevated food price pressures globally are still trickling in to South African data. So what we're seeing currently with softer commodity prices internationally, those prices have come off of late. We're still yet to see those benefits. I think from a South African perspective, we're still dealing with the lagged impact of those elevated global food prices still coming through to South African ports. On top of that, producer price inflation has been quite elevated.
Oh, all right. Unfortunately, we've lost Koketso Mano, who's a senior economist at FNB. We're going to... Oh, she's back. Okay. Koketso, thank you very much for joining us. Again, just quickly as we round off, just give us a sense of what your expectations are from the Reserve Bank, which is making its call on interest rates tomorrow.
For some time, and we think that the pass-through way and is posing upside pressures are remaining elevated at least until the first
Apologies, Koketso, we lost you for a second there, but I'd like to just ask you very quickly what your expectations are from the Reserve Bank tomorrow.
Yeah, apologies for the network. So our expectations are for the NPC to hike interest rates by 75 basis points. This is in line with globally fast tightening monetary policy or globally tightening financial conditions. So following the Fed's interest rate decision today, which is also expected to be 75 basis points or higher, we think that the MPC tomorrow, the South African Reserve Bank MPC, is likely going to hike itself by 75 basis points. The inflation figures are not the same across the board. We don't have as strong inflationary pressures in South Africa. However, the MPC is likely going to remain focused on keeping inflation expectations anchored or contained around the 4.5% mark. As we know, if they allow inflation expectations to move away from their preferred anchor, it is likely going to result in a wage spiral. For example, a lift in inflation expectation does create these expectations to filter through to wage negotiations, price determinations, and the MPC will want to avoid that because that also will result in a broadening of inflationary pressure across the basket as we see that lift in core inflation. So as per the primary mandate of the South African Reserve Bank, we think that they will remain focused on anchoring inflation expectations, hiking by 75 basis points tomorrow to 6.25%.
Koketso, before I let you go, you've touched on very important issues there, especially around the wage inflation spiral. We're hearing that the public sector or parts of the public sector workers are planning on going on a strike. They want, close to double-digit increases. And we've been told by the likes of National Treasury, and it's been echoed by yourselves as private sector economists, that this would blow out public spending. How concerned are you about this, and how much of a concern will this be for the Reserve Bank as they make their decision tomorrow?
Yeah, and I think the Reserve Bank has already mentioned in previous hearings or statements that, they are concerned about a wage spiral as especially you might think about it as supply side dynamics, which monetary policy does not have a very strong impact on. So that would include your fuel dynamics, your food dynamics. However, this does affect the men on the streets, and as I spoke into this earlier in this interview. So this is likely going to result in them seeking to claw back some of these price pressures in their wage negotiations, trying to recoup some of those inflation pinch that they're feeling when it comes to the food inflation or fuel inflation, public transport, for example. So we do generally expect that these types of wage negotiations and demands will still come through, but it is going to be very important for the Monetary Policy Committee to make sure that this wage spiral does not structurally lift inflation, right? So what is something that could be temporary through food and fuel inflation might end up being something more permanent when you look at your structural inflation dynamics. And that is something that they're going to be very focused on and concerned about. They've mentioned this already. And obviously on the Treasury side, it does risk the fiscal consolidation path, which is also something that we're also concerned about. But I mean, as I've said earlier, it does make sense to expect that these demands would be coming through when you look at some of those price dynamics that are affecting your lower income groups especially.
Absolutely. Koketso, thank you very much for your time. That was Koketso Mano. She's a senior economist at FNB.